The global energy demand is one of the main reasons why we have a positive long-term outlook on commodities. In this video, we will explain why investing in commodities is so important. The question now is not whether we will consume more energy in the future, but which energy source. Stay tuned. Hello everyone and welcome to Geopolitics and Money, the #1 channel where finance, commodities, geopolitics, and investing intersect. Our mission is to furnish you with cutting-edge analysis and trends in the spheres of precious metals, digital assets, commodities, and investing. By opting to subscribe to our channel, you'll be empowered with the tools and knowledge necessary to stay one step ahead of the curve, always in the know about the latest developments. Since the invention of the steam engine in the 1800s by James Watt, energy consumption in the world has exploded. With a few short-term fluctuations, the pattern of global energy use has followed the so-called hockey stick pattern. There's currently no reason to believe that this pattern will change quickly. In fact, the question now is not whether we will consume more energy in the future, but which energy source. For example, this chart shows global energy consumption over the last 56 years, since 1966. Apart from the recession in the 80s, the Great Financial Crisis of 2008, and the COVID crash, global energy demand has been growing at a rate of around 3% per year. While energy demand in developed regions such as Europe and the US is comparatively constant, the rest of the world exhibits a high appetite for more energy, with some nations experiencing an annual surge of 10% to 15%. So the question is, where does our energy come from today? Although the world has been investing heavily in renewable energy for many years, the bulk of our energy supply still comes from fossil fuels. Oil, coal, and natural gas still account for more than 80% of global energy supply. Although everyone wants a greener and healthier environment and everyone wants to breathe clean air, the reality is that we are still heavily dependent on fossil fuels. And this will not change quickly, whether we like it or not, simply because this energy transition requires an enormous amount of money. The United States has spent more than $2.5 trillion in recent years on greening its economy, yet solar energy accounts for only 1.5% and wind energy about 3% of the energy mix. Renewables as a whole account for just 12%. So we need a lot of fossil fuels. Time to talk about oil. The global oil production has grown in recent decades, but so has the world's population. The oil consumption per capita has barely decreased since 1991, going from 4 barrels per day to 3.5 barrels per day. Energy consumption is therefore growing almost 1-to-1 with the world's population. And while the population in developed countries remains relatively stable, there is tremendous growth in developing countries. The world's population is estimated to grow by another 25% in the next 25 to 30 years. If you consider that energy consumption grows 1-to-1 with the world's population, then the production of renewable energy, for example, also needs to grow by 25%. This means that the demand for fossil fuels will remain the same as it is today. The next question we need to ask is, where is all this oil going to come from? The oil production of OPEC is almost the same as it was in 2004, and there is little to no spare capacity left. The shale revolution in the US has peaked. And Russia? Well, that goes without saying, of course. Normally, high oil prices are the best means for oil producers to invest massively, but that is not what has been happening in recent years. Global capital expenditures for oil and gas production are still 60% below the peak of the previous commodity bull market. In 2022, U.S. oil and gas producers slightly increased capital expenditures for the first time in 4 years, but in Canada, it is still at a low point. The rest of the world remains almost at the same level. So that means that a much higher price for fossil fuels is needed to increase capital expenditures to meet demand. And then the world still needs to reduce emissions by 43% by 2030 to meet the Paris climate agreements. To pull that off, we have to look at metals. We can reduce emissions by focusing on green energy, such as electric vehicles, but electric vehicles require about 5 times more metals than fossil fuel-powered vehicles. A lot more copper, but also nickel, cobalt, graphite, zinc, lithium, and more. But these raw materials are not only needed for electric cars, because, of course, we're not just going to drive around in a green car to save the environment. The production of offshore and onshore wind farms and solar energy also requires much more raw materials than is needed for natural gas or coal production. Again, we will need much more copper, lithium, nickel, zinc, and other metals. We are going to need these metals in large quantities, while there has been little investment in recent decades. The reason for the lack of investment is not only due to the depletion of easily accessible resources, but also because the funding for these projects has been affected by the emergence of ESG considerations. Let's take copper, for example. This graph clearly shows that the times of major copper mine discoveries are long gone. Although we like to believe in fairy tales that green energy will replace fossil fuels and polluting mining activities, the reality presents a totally different picture. That makes the energy sector very interesting to invest in right now. In conclusion, we can say that global energy demand continues to increase. Global energy supply is under pressure. Investment in fossil fuels is too low. Commodity prices are likely to remain high for a long time. That's it for today's episode. Please leave a comment below to let us know how you view the energy sector and possible investments. Thanks for watching. Please subscribe so you'll never miss a new episode. See you in the next one.